Welcome to The Explainer. Today, we're going to tackle a topic that might seem a little intimidating at first, but trust me, it's absolutely essential if you want to understand a company's real financial health. We are unlocking the secrets of something called IFRS 7.
Okay, let's just dive right in. You know that feeling? You're reading a company's annual report, you see all the big numbers, but you just get this nagging sense that there's something more going on behind the scenes. Well, that's because a lot of companies use these complex things called financial instruments. We're talking derivatives, intricate loans, all sorts of investments. And honestly, it can feel like a total black box, maybe even hiding some pretty big risks from plain sight.
But what if there was a key designed specifically to open that box and let you see exactly what's inside? Well, there is, and that key is an international accounting standard known as IFRS 7.
Now hold on. Don't let the words accounting standard make your eyes glaze over. This is not just some dry rulebook for accountants, I promise. A better way to think about it is as a required user manual and, maybe more importantly, a safety warning label for a company's entire financial toolkit. Basically, it forces them to tell us what's going on.
So at its heart, IFRS 7 has two really clear missions. It's built to help people like us, the ones actually reading the financial statements, answer two huge questions. First, just how important are these financial tools to the company's bottom line? And second, what kinds of dangers do they create? And just how big are those dangers?
Let's tackle that first question, because it's kind of the foundation for everything else. Before you can even begin to understand the risks, you have to know the scale of the whole operation. IFRS 7 makes companies show us exactly how much they're relying on these instruments to run their business and, well, to make a profit.
And they can't just be vague about it either. The standard demands the nitty-gritty details. In the notes of their financial statements, the part a lot of people skip, companies have to lay out the hard numbers. The value of these instruments on their books, the profits or losses they've made from them, the interest and fees they're paying or earning. This is how you can figure out if a company's profit is coming from its main business or from some risky side bets.
Okay, now for part two, which I gotta say is probably the most interesting part. Understanding the risks. It's not enough to know what tools a company is using. You really need to know how they could blow up in their face and what management is doing to stop that from happening. And this is where IFRS 7 shines a huge spotlight.
First up, you've got credit risk. And what's great about this is that it's a really simple concept at its core. It is just the risk that somebody who owes the company money, whether it's a customer, another business, whoever, simply won't pay it back. For a bank, for example, the ultimate credit risk is the fear that thousands of people could default on their mortgages all at once.
Next is liquidity risk. This one is the stuff of nightmares for a CFO. It's the danger of literally running out of cash. A company could be profitable on paper, but if it doesn't have enough ready money to pay its own bills when they're due, it's in big trouble. Just think about a construction company that finished a massive project but won't get paid for another 90 days. It still needs cash right now to pay its crew. That's liquidity risk.
And finally, we have the big one, market risk. This is the risk that huge market movements, things totally outside of the company's control, could completely wreck their finances. So if you're an airline and you haven't locked in your fuel price, a sudden spike in the cost of oil could totally wipe out your profits for the year. IFRS 7 forces companies to tell us just how sensitive they are to these kinds of changes.
So how does IFRS 7 get all this info out of them? Well, this is the brilliant part. It demands both qualitative and quantitative disclosures. The easiest way to think about it is like this. Qualitative is the story. They have to actually explain how they manage risk, in plain English. And quantitative is the data. They have to show the hard numbers that reveal how much exposure they really have. You absolutely need both to get the full picture.
And it's really important to remember, this standard isn't some ancient rule set in stone. No, it's a living, breathing document. It was first issued back in 2005, but it got a massive update in 2009, and that was a direct response to the global financial crisis, which showed just how much risk was hiding in the system, and it keeps getting amended to keep up with the wild and ever-changing world of finance.
So, after all that, what's the payoff? Why should you, an investor, a student, anyone who's curious, actually care about all these disclosures? Well, it all boils down to one word: empowerment. It's about being able to see what the people running the company see.
And hey, you don't have to take my word for it. The standard's own objective, right there in the very first paragraph, says it all. This information is not just for auditors or regulators. It is specifically there to enable users, that's you, to make better evaluations and more informed judgments.
So, what can you actually do with this knowledge?
You can look past the flashy headline revenue and profit numbers. You can get a real feel for a company's appetite for risk. Are they playing it safe, or are they gamblers? You can even compare their strategies to their competitors. And at the end of the day, all of this helps you make smarter, more confident decisions with your money.
So here's the bottom line. IFRS 7 isn't just another boring accounting rule. It's a tool for transparency. It's what turns that financial black box into a clear glass case, giving you the power to see the entire picture. So the next time you open a financial report, don't just glance at the front page. Dig into those notes, look for the IFRS 7 disclosures, and see what story the company is really telling.